You're watching Stock Watch this week. I'm Umthombo, and joining me to unpack your stock-related questions today in studio, Chantal Marx from FNB Wealth and Investments, and via Zoom, Alex Duys from Umthombo Wealth. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Chantal, Alex, thanks so much for joining me this afternoon. Now, Chantal, I spoke to you yesterday, right, about a recovery in markets, and you were very cautious about that recovery, and rightfully so, because what we're seeing today is totally different. Markets really yo-yoing between green and red, because, you know, like 24 hours makes a really big difference. We really are living in unprecedented times, and I can imagine how difficult it is as a market analyst, as an economist, to make these forecasts when we don't know what is happening.
Absolutely. I mean, we're still living through the start of it, right?
Yeah.
So we're getting used to the idea that we don't know what's going to come out of the White House from one day to the next. And we need to get to grips with that reality. And I think that most analysts and forecasts, if they're honest with themselves, have absolutely no clue what's going to happen over the next 4 years. So we need to get to grips with the new reality, and then you can start thinking about forecasting. But for now, I think everything is up in the air. The world being as interrelated as it is, and some of these economic and market concepts being as interrelated as it is, means that if one thing changes, almost everything changes. So now we need to understand how everything changed.
You know what this reminds me of? It reminds me of the time where we didn't know what central banks were going to do. One forecast says, hey, they're going to cut in January. The next forecast says, no, in September. And it's really confusing times, interesting times indeed. And I think it's going to be interesting for the next 4 years with, you know, Trump in power. Now, Alex, unprecedented times, as I mentioned. How do you then navigate these kind of markets where trade is really choppy and it's really volatile?
Yeah, so it is certainly not easy. Luckily, I've been around for a while, so I'm trying to think back of what happened in previous cycles. So, global financial crisis, Greek debt crisis, you know, COVID, and so forth. And, you know, I think the best is to, obviously, you know, your emotions start running quite ahead of yourself. So you should be careful not making knee-jerk decisions. But these type of markets does give you opportunity to upgrade your portfolio.
Yeah.
So, you know, make sure you've got enough dry powder available, either through cash or perhaps stocks that do well in this cycle, like illiquids or perhaps a gold and so forth, and recycle that into quality stocks if the prices present itself. So I think that's going to be my strategy again going forward as well. So I agree with Chantal. We are still in early days. Who knows what's going to pan out? And China could come to the negotiating table within the next hour, or they could refuse to do so at all. So that type of uncertainty will create problems and so forth. But see it as opportunity to invest and be careful to make knee-jerk emotional decisions, because you most likely will damage your not only your performance but also your future performance.
So opportunities to invest, and what we've seen from a number of our viewers, a number of the questions coming through, we are seeing a trend where there seems to be a flight to safety. Many asking how to invest in gold. Should it be through an ETF? Should it be through a mining counter?
So that it's very interesting how emotions in markets work. So people tend to flock towards the stuff that's going up, and they tend to avoid the stuff that's going down. But often when you see market volatility like this, and particularly when you're in a bear market, as is the case in the US, you should actually be doing the opposite. You should be looking to add risk to your portfolio, but in a measured way, right? You don't want to buy deep value stocks or very cyclical stocks at these levels or where we are currently, but you can start thinking about the defense, not the defensive areas, but kind of long-term growth stocks that were always expensive, but now suddenly they're starting to add some value. The temptation is there to start flying to safety, to sell stuff that has fallen a lot because you're fearful that they're going to fall more, put that money in cash, or to really focus and zone in on something like gold. I don't think that gold is a bad investment currently. It's just the easy money has already been made. So now if you really want exposure to gold, you need to start thinking about what the vehicle is going to be. It's probably not going to be a gold exchange traded fund. We can still see upward pressure on the gold price, but as I said, the easy money's been made. On the mining side, some of these companies look really expensive now. They've rallied very hard. I'm thinking particularly about Harmony Gold. So you can think about maybe looking at an Anglo Gold or a Pan-African companies that have lagged in the current gold bull run to express that view. But I would actually be using gold and gold mining shares as a funding mechanism once I identify something that's really great, but that's on sale currently.
And Alex, what are your thoughts around, the gold counters? Are any of those companies looking attractive to you?
I mean, gold is something you buy as insurance for future unexpected events. Now that event has happened, it's or process of happening. So you don't buy insurance now. So ideally, would like then now to use this very high gold price or gold share prices levels to sell and then buy other assets, specifically the quality assets I refer to at better prices. So I would be careful to do the herd mentality, as Chantal says, and just simply change what makes you comfortable. You can still perhaps play gold differently if you still think it's going to do well. For example, something like African Rainbow Minerals has got a stake in Harmony. I haven't checked the numbers this today, but the last time I checked a day or two ago, it was about 87% of African Rainbow's market cap was a stake in Harmony, as well as the cash they had on the balance sheet. So that's a cheap way of getting access to something like Harmony. There's probably more than that now, because Harmony has now gone to, I don't know, 320 or something like that. So so that could be perhaps a way, or you look relative in the shares, as Chantal mentioned, perhaps a pan looks better than Harmony or something like that. But be careful to do the so-called insurance trade when it might be already too late.
So you talk about, Alex, being careful to make the insurance trades, and Chantal also mentioned looking for opportunity in stocks that have run, and now we are seeing those counters coming down. This makes me think of the tech sector, the US tech sector in particular, and over the past week we've seen how much value Apple has lost. There's a question here around whether it's the right time to nibble on Apple.
Sorry, asking me.
Yes, Alex.
Yeah, so I think obviously a big issue with Apple is supply chains, right? So with China and so forth, so there's some uncertainty there. And also the impact we have on just your global consumer on these products. So, and on top of that, the valuations were very high for these companies. So any form of negative news or impact on earnings will lead to a derating in stocks, specifically growth-related stocks. They are very sensitive to changes in earnings estimates, and we've seen that across the board. Now, to be honest, the AI or Magnificent 7 stocks have been falling now for a while, ever since DeepSeek, the AI from China, has happened. So that was, I would say, the first start that perhaps these valuations are not sustainable. And on top of this, we've got all the complexity when it comes to the tariff situation. These companies will still produce good returns and so forth, but we'll have to see in the upcoming earnings season what the guidance looks like. But as I alluded to, they are very sensitive, these growth stocks, to earnings estimates. If earnings estimates are downgraded even by a few percentage points, it could have a detrimental impact on the valuation or rating of the stocks.
And your thoughts around these growth stocks? I mean, as Alex mentioned, we've seen the prices come down this year just on the back of the emergence of DeepSeek. Is it the right time to perhaps look at one of the quality stocks and, buy into it because of the prices are quite low, well, relatively low?
Yeah, so I think that two things drove the initial outperformance of these tech stocks included in the Magnificent 7 and even beyond that. The first thing was that we saw massive increases in earnings expectations, and those were generally correct in the environment that we were in prior to February this year. We kept seeing these guys beat earnings expectations, cash flows were really strong, profitability was improving, and then we had a re-rating as well, where the valuations actually picked up on a relative basis. So the stocks became more expensive. And what we've seen over the last few months is an unwinding of that rating. And I think the risk now is that we're going to start seeing downgrades to analyst estimates, as Alex mentioned as well. Once we start seeing that rating can come down. Well, that rating will come down because the growth prospects is less. And then also the ratings will be inflated because suddenly the earnings figures are slightly lower than expected. So my feeling around US tech at the moment is that's probably a little bit too early.
Okay.
I'd wait a little while longer for the ratings to either start reflecting kind of reduced growth expectations and for it to come to fall below what the average ratings have been, because now at the moment they're kind of trading at average multiples, 5-year, 10-year multiples, they can go even lower in an environment as uncertain as this one.
And Chantal, what are your general thoughts around U.S. markets? I mean, there's been talk around U.S. markets losing their exceptionalism as we start seeing a rotation into European stocks, into Chinese stocks.
So I think that the US exceptionalism narrative was very convenient because we had these massively high valuations and the stock market continued to push higher.
Yeah.
You also did, in reality though, have a situation in the US where employment was extremely buoyant. So the labor market looked really good, consumer confidence was decent, the economy was humming along quite nicely. This has been derailed now. I think there's been a hit to confidence and there's a lot of fear among US consumers that there could be job losses coming, that inflation is going to tick up because of tariffs. So I think US exceptionalism, that narrative has been, it's being countered at the moment, perhaps just momentarily, but it's being counted at the moment. So now it doesn't make sense for US stocks to be as expensive as they were. And that's why I think that you're seeing investors look at other markets. They're looking at the Chinese market that's been cheap for forever, perhaps not as seriously at the moment because they're the ones that headlining the trade war with the US is headlining a trade war with China. And then a lot of interest in the European market in particular. That market is not that cheap, but there are some very high quality companies there. And a lot of those companies, I think, are probably slightly less prone to kind of the cyclical factors and some of the issues that's emanating out of the US.
And Alex, are you seeing opportunity in perhaps the European markets or Chinese markets?
Yeah, so as Chantal says, the European market, I mean, quality companies there, but there's been a lack of innovation in those markets for the last 20 years, pretty much. And it does seem like now, specifically like Germany, looking to do a so-called fiscal bazooka, spending lots on infrastructure as well as getting the military spending up and so forth. And hopefully this brings an age of some innovation and so forth to Europe. But there are obviously different countries you have to look at. So, for example, the UK's got its own problems, and France is going through issues. So, it's difficult to say which companies, what countries in Europe to buy. But perhaps a basket of European shares will probably do relatively better than some other developed markets at the moment.
You speak of
China certainly has had. Sorry.
No, you can go on.
So China certainly has had a strong rally end of last, beginning of this year. That's around a little bit. But China is under the threat of the trade wars, right? So there is a temporary problem there for them. But structurally, the valuations are still looking good. Companies should have decent prospects. So on a relative basis, Asia is looking quite good, in my view. But obviously not go gung-ho, but there are certainly selective exposure there. Japan, for example, also has pulled back quite a lot. South Korea has been on a lot of pressure. So there's certainly opportunities in the East.
All right. Chantal, there's a question here around buying into the greenback, the dollar. I mean, you know, there's expectations that usually when we're hit by tariffs that the dollar strengthens, but we haven't been seeing that with the dollar decreasing. So the question says, how can we get into the greenback through index funds or like the global index funds in USD or Global Leaders Fund or World Access Fund?
So this almost feels like the gold question as well, because even though the dollar has weakened relative to other currencies, it has not weakened against the rand. The rand has been weaker than the dollar. So if you're a rand-based investor, you're sitting at a 1930 to 1950 kind of 1960 even trading range on the rand. The rand is undervalued, the rand is too weak. So if you're going to take the rand now and buy dollars, I don't necessarily think it's the best time to do that. You would want to wait for the rand to strengthen slightly. If you're really nervous about your rand exposure and you really want US dollar exposure, then you can express that by buying US dollar-based assets.
Okay.
Be that on the JSE, be that in the form of a unit trust or an index fund overseas. And you can also, of course, buy dollars directly from most of your banks.
Do you share the same sentiments, Alex?
Yeah, I certainly do. So, I mean, let's take South Africa, for example. So if the GNU worst case scenario doesn't pan out, then you probably will see a strengthening of the rand. I think that's been currently priced in that the GNU is not going to survive and so forth. So be cognizant that we could get a better buying opportunity. if you do believe there's no more futures in Africa and you want to get your money out, then I guess at any price it's worthwhile to consider to buy dollar or other currency assets.
Now, sticking with you, Alex, let's get into some local stocks, right? Not sure if you look at this one, but there is a question around Reunert and the merits behind investing in that company.
Yeah, certainly. I do like Reunert at the current levels. It's pulled back, sure, must be close to 30% over the last few months. So Reunert has got major divisions specifically in electrical cabling. So they are going to be big in Eskom's transmission, which is obviously the splitting Eskom in three components. So what Eskom want to do is they want to build a new transmission line so that we can add the new renewable power plants to those lines. But doing that, you obviously will need cabling, and Reunert will be able to supply that. They're one of the main suppliers of that. So there is a structural growth story there over a number of years. We've also got an ICT business. They've done a deal with ICOS about, 2 years ago. They have had some problems there, but there seems to be, potential there. And then they've got the business which focuses on global defense, specifically radars and radios that they sell into Europe and so forth. And I think global defense spending is going to go up substantially, not only in Europe, but also in the US. So that business is well positioned. So, buying Reunert at a P of less than 10, we think earnings growth rates will easily be high single digits, if not double digits. So we think it's quite a compelling one at the moment.
I see you agreeing, Chantal. Do you also see, merits in investing in Reunert? I find that global defense exposure also really interesting.
Yeah, I mean, Reunert is a very interesting business if you actually take the time to get to know the business. I think it's one of those companies where at first glance you're like, oh, it's so boring.
What do they do?
What do they do? And there's all these little component parts, but ultimately it's an SA industrial company. It is exposed to the renewable energy thematics. It's exposed to infrastructure investment in South Africa, which we know has been delayed, but that government is very serious about. And then of course that exposure to defense as well. So it's a really interesting one. It did exceptionally well last year, but we have seen it derate a little bit this year so far. Well, not a little bit, a lot of it. And I think it's probably a good opportunity to invest. It's a highly cash generative business. They also pay a really attractive dividend.
Okay, so one to actually look at and perhaps add into your portfolio. I also had a conversation with you around platinum stocks yesterday. There is a question on Wesizwe Platinum. I know this is not a stock you particularly look at, but are you actually seeing value in some of the other platinum players? You did say that you've been hurt before.
Yeah, I have been hurt before because I think I became a little bit. I became a little bit more too optimistic too soon.
Okay.
Right. So platinum is in a deficit, or PGMs generally is in a deficit currently. But because of the demand issues that have been faced by the automotive industry, there was actually too much supply above ground. And that backlog seems to have started clearing now. So we are hopeful that we could start seeing some support for PGM prices over the next few months, unless the growth narrative is drastically changed, right? Because that is also a risk in the current environment. But I think that the PGM price is too low. It should go up at some point. And in terms of our preferences within that space, Northam is very high quality. They've got high quality assets. Similarly, Amplats is also a really good business. Implats is starting to look a little bit better. But I think that there's still a lot of operational concerns there. And Sibanye is a higher cost producer with exposure to US mines, which I think has its own complexities attached to it.
All right, Alex, do you share the same sentiments, and do you actually look at Wesizwe Platinum? Let's start there.
I do not look at Wesizwe, unfortunately. I mostly concur there with Chantal on GMs. My only concern is I don't know how long this down cycle is going to be.
Yeah.
The previous down cycle was many, many years. And these balance sheets were then materially destroyed, and we eventually saw M&A happening. For example, London had to be saved by Sibanye as well as Aquarius Capital, Platinum and so forth. We haven't seen that yet. These companies are still predominantly in their cash position. We haven't seen anyone really going at risk of going out of business. And the chrome price is helping them to sustain to some extent. So you could make an argument it's going to take some time before we're going to start seeing eventual supply coming off, because that is going to be required. We need to see some supply coming off. And of course, that does have political ramifications and social ramifications, not easy decision to make. So that's difficult. I think that still needs to happen. But in general, I do think at some stage PGMs will make some form of recovery. We're more positive on a platinum price than compared perhaps to palladium price. And then rhodium is the outlier. You just simply don't know what's going to happen to rhodium. But rhodium was one of the key reasons for the previous upcycle in PGM. So, if there's supply issues, and specifically on the Western Limb, could be good for rhodium. I don't know, but I'm cautious. So if you're cautious, I prefer Amplats. That's more defensive. If you're a bit more bullish on PGMs, my preference would be for Impala.
So a sector rather to look at if you feel a bit risky, hey, if you feel like you want to take some chances. Let's look at another question. As I mentioned that, I'm sticking with you, Alex. I mentioned that most of our viewers are really panicking as we've seen markets really fall off. And there's a question here on Old Mutual. The viewer says it seems to be on a continuous decline. Should I hit the panic button and count my losses and get rid of Old Mutual shares?
Sure, Old Mutual shares been under a lot of pressure. I don't really like the business much because, and I'll give you a few reasons. So I think operationally, they have gone backwards for a number of years now. A big chunk of the earnings is actually market-related earnings. And if the market selling off as we're seeing now, that earnings is going to evaporate in the next reporting period. Quality of earnings is also not particularly good in Old Mutual, and we think they've lost their mojo a little bit. Still got an exceptional brand, and they should be doing a lot better than what they are doing. So there is optionality there. My preference is clearly for Sanlam. They've got much better quality of earnings, much better growth prospects, much better management. So if you do a switch out of Old Mutual Sanlam, I think that can be considered, but I'm quite reluctant to want to sell Old Mutual at these levels because it is so undervalued. I think it's probably now close to 50% of EV. So it's probably not the best time to exit, but it's not my preferred entry point in that sector.
All right, I'm going to give you another stock, Chantal. There is a question here around Exxaro and if you are seeing opportunity to get into the stock at the moment. I mean, we've seen quite a lot of shifts on that front. They are trying to really push through their green metal strategy. We've also seen a changing at the guard as well.
Yeah, I mean, we've had some volatility at the top in Exxaro over the last few months, and that's always a red flag to me. So then I just simply stay away from the stock. The other issue with Exxaro, which is very difficult to solve, is that they remain extremely exposed to thermal coal. Now, thermal coal is an asset with a declining addressable market. It's a commodity with a declining addressable market over time. So they have to step in and do something else. I think that the transition to the renewable strategy has been a little bit on the slow side. And from what I understand, they've also struggled to get their coal out. So they've spent a lot of additional money on logistics costs over the last few years. And I'm just scared that that's going to continue or it's going to be slow to turn around. One of the key reasons why you would own Exxaro is because it generates a lot of cash and it gives a lot of cash back to shareholders, also through its holding in Session Iron Ore. So from a just long-term investment, I'd wait for that portfolio shift to take place so I can get a better idea of what it's going to look like. You can get some decent cash returns from it, but yeah, I think that it's a little bit too risky for me at the moment.
Okay, so not too sure about Exxaro. What are you sure about? What's your stock pick today?
So we spoke earlier about European stocks and that there are some really high quality companies in those markets that are trading at discounted prices. Now, I'm not going to say this is a cheap stock because it's not a cheap stock. It is an expensive stock. It's just become less expensive. But it's all about the product that they sell. Ferrari sells Ferraris. That is what they sell. They have their cars are sold 2 years in advance, or they've already pre-sold cars 2 years in advance. So that's the next 2 years revenue covered, right? They've got this philosophy of always producing one less car than the market demands. So demand is actually much higher than supply for their product. And they actually themselves don't know what the right price for a Ferrari is. So it's a Veblen good. the more expensive it becomes, the more desirable it becomes. And people who can afford Ferraris generally tend to be more resilient financially through all market cycles. So I think pretty defensive, and you're getting it at a bit of a discount.
I wish I could afford a Ferrari.
Me too.
Unfortunately, I can't. You can't. But Alex, what are you picking today? What's your stock pick?
Yes, I'm still quite nervous, as I said Monday on the show. But I think Reunert for me is an interesting option.
Okay.
About half of its market cap is currently in cash because of this. They sold the British American backers stake, and it's still trading at a big discount to that valuation. So I think that's quite a relatively safe place to hide. Doesn't really benefit that much from the weakening rand or to the euro as well. So I think it's a high quality assets because specifically got exposure to a business called Pension Investment Corp. I think it's got excellent growth prospects in the UK. And you're buying it at high margin, I say, because of the cash component and at a big discount to that cash as well. So I think it's a safe place to hide for the time being. And if you're right, make quite good returns as well in euro terms.
So Reunert and Ferrari ones to look out for. Thanks to my guests, Chantal Marx from FNB Wealth and Investments and Alex Duys from Umthombo Wealth. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 on Fridays. Keep that in mind and keep your questions coming. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.